Welcome back to the Daily Crypto Roundup. Today we have a packed episode because the crypto market is sitting in one of the most fascinating positions we've seen in weeks. Bitcoin is hovering near a major technical level while billions of dollars in leveraged positions sit at risk of liquidation. Ethereum traders are defending a key support zone that could determine the next big move in the second largest cryptocurrency. At the same time, institutions are showing surprising resilience, holding through massive volatility instead of fleeing the market. And perhaps most dramatically, Michael Saylor's strategy has just made another gigantic Bitcoin purchase worth more than $1.5 billion, adding tens of thousands of coins to its already enormous treasury. All of these developments together paint a very interesting picture of where the crypto market may be heading next. Let's begin with Bitcoin, because the market is currently sitting on what many analysts describe as a liquidation pressure point. According to recent data, more than $2 billion in long positions could be liquidated if Bitcoin falls below a key support level near $70,000. This is a massive amount of leveraged exposure that traders have placed on the expectation that Bitcoin will continue moving higher. When a liquidation occurs, the exchange automatically closes the leveraged position, which means the asset is sold into the market. When enough of these liquidations trigger at the same time, they can create a cascading effect that pushes the price down even further. On the other side of the market, there is also a large cluster of short positions waiting above the current price. If Bitcoin breaks upward through resistance around the mid-$70,000 region, more than $1.5 billion worth of short positions could be liquidated. In that scenario, traders betting against Bitcoin would be forced to buy back their positions, which could push the price sharply higher in what is commonly known as a short squeeze. This kind of setup creates a situation where the market is effectively compressed between two potential explosive moves. Traders often refer to this as a leverage squeeze zone. The longer the price remains trapped in this narrow band, the more pressure builds inside the derivatives market. When the breakout eventually happens, it can lead to extremely rapid price movements as forced liquidations add fuel to the momentum. We have already seen some signs of this volatility in the last 24 hours. Hundreds of millions of dollars in positions across the crypto market have already been liquidated as prices fluctuated. Bitcoin alone accounted for a significant portion of those forced closures. However, the larger liquidation clusters remain intact, meaning the real move may still be ahead of us. Now, while traders in the derivatives market are nervously watching these levels, there is another group of investors behaving very differently. According to comments from Bitwise Chief Investment Officer Matt Hougan, institutional investors showed remarkable discipline during the last major Bitcoin correction. When Bitcoin experienced a roughly 50% drop from its previous highs, many analysts expected large institutions to panic and exit their positions. Instead, something surprising happened. Institutional investors largely held their positions through the downturn. Hougan explained that many critics of Bitcoin had assumed that institutions would treat the asset as a short-term speculative trade. The expectation was that once prices began to fall, large funds and corporate treasuries would rush to sell their holdings in order to protect profits or limit losses. But the data suggests that the opposite occurred. Institutional investors held on to their Bitcoin allocations, demonstrating what the crypto community often calls diamond hands. This behavior is significant because it indicates a shift in how Bitcoin is perceived by major investors. In earlier cycles, the market was dominated by retail traders and speculative capital. That environment tended to produce extreme boom and bust cycles where prices would surge rapidly and then collapse just as quickly. But the increasing presence of institutional investors may be changing that dynamic. When institutions allocate capital to Bitcoin, they often do so with a long-term investment horizon. Many funds treat Bitcoin as a strategic asset similar to gold or other stores of value. This means they are less likely to panic during short-term volatility. Instead of reacting emotionally to market swings, they tend to focus on long-term fundamentals such as adoption, monetary policy trends, and the role of digital assets in the global financial system. If this trend continues, it could gradually stabilize the Bitcoin market over time. Large institutional holders absorbing supply during downturns may reduce the severity of future crashes. At the same time, The growing number of exchange-traded funds and corporate treasury allocations could create a persistent base of demand that supports higher long-term price levels. One of the most dramatic examples of this institutional conviction can be seen in the actions of Michael Saylor and his company Strategy. The firm, which many people still remember under its former name MicroStrategy, has once again made headlines with another massive Bitcoin purchase. According to the latest filings, Strategy bought more than 22,000 additional Bitcoin during the past week. The total cost of the purchase was approximately $1.57 billion, with an average acquisition price just above $70,000 per coin. This purchase brings the company's total Bitcoin holdings to more than 760,000 coins. To put that number into perspective, Strategy now controls well over 3% of the entire fixed supply of Bitcoin. Because Bitcoin has a maximum supply of 21 million coins, every large accumulation by long-term holders reduces the amount of Bitcoin available in the liquid market. Michael Saylor has been one of the most outspoken advocates of Bitcoin among corporate leaders. Over the past several years, he has repeatedly described Bitcoin as the most efficient store of value ever created and has argued that companies holding large cash reserves should consider allocating a portion of those reserves into the digital asset. Strategy's approach has essentially transformed the company into what some analysts call a Bitcoin treasury vehicle. Rather than simply holding Bitcoin as a passive investment, the company has actively raised capital through stock offerings and debt instruments in order to acquire even more coins. This strategy has allowed Strategy to accumulate one of the largest Bitcoin treasuries in the world. The latest purchase was partly funded through the sale of preferred shares, which raised over $1 billion in new capital. Those funds were then used to acquire additional Bitcoin at what the company clearly views as an attractive long-term price level. Saylor has consistently argued that Bitcoin represents a superior alternative to holding large amounts of cash or low-yield bonds. In his view, Bitcoin's fixed supply and global accessibility make it an ideal asset for preserving value over long-time horizons. Whether or not one agrees with that thesis, there is no denying that Strategy's continued accumulation sends a powerful signal to the market. When one of the largest corporate holders of Bitcoin continues to buy billions of dollars worth of the asset even during periods of volatility, it reinforces the narrative that major investors see long-term value in digital assets. Now let's shift our attention to Ethereum, which is also sitting at an important technical crossroads. Analysts have been closely watching the price action around the $2,000 level, where a large number of leveraged long positions are concentrated. According to derivatives data, roughly $1.8 billion worth of Ethereum long positions could be liquidated if the price drops into a key support zone just above $2,000. As we discussed earlier with Bitcoin, liquidation events occur when traders using leverage no longer have enough collateral to support their positions. When that happens, exchanges automatically close those positions, often by selling the underlying asset into the market. If Ethereum were to fall into this liquidation cluster, it could trigger a rapid cascade of selling pressure. Each forced liquidation adds additional downward momentum, potentially accelerating the decline. However, Ethereum bulls have been actively defending this support area. Buyers stepping in near these levels suggest that many traders view the current price range as an attractive entry point. If Ethereum continues to hold above support and begins to build upward momentum, analysts believe the next major resistance zone could appear around the mid-$2,000 range. Some projections suggest that a sustained breakout could eventually push Ethereum toward the $2,800 level. Achieving that target would likely require renewed confidence across the broader crypto market as well as continued demand from both institutional and retail investors. The Ethereum ecosystem continues to evolve rapidly, with developments in decentralized finance, Layer 2 scaling solutions, and tokenized assets attracting increasing attention from developers and financial institutions. These underlying fundamentals remain one of the key drivers of long-term optimism for Ethereum supporters. At the same time, the market remains highly sensitive to macroeconomic factors. Interest rate expectations, global liquidity conditions, and geopolitical developments all influence investor appetite for risk assets like cryptocurrencies. When traditional markets experience turbulence, crypto prices often react quickly as traders adjust their exposure. This means that even though the crypto market has matured significantly over the past decade, it is still closely connected to broader financial conditions. Investors watching Bitcoin and Ethereum are not only studying blockchain metrics and adoption trends, but also monitoring inflation data, central bank policies, and global economic signals. Putting all of these pieces together, the current crypto market landscape reveals several important themes. First, leverage in the derivatives market continues to play a major role in short-term price movements. Large clusters of liquidations can create rapid volatility when key levels are breached. Traders must remain aware that sudden moves in either direction can trigger cascading effects that amplify momentum. Second, institutional participation appears to be strengthening the long-term foundation of the market. The fact that large investors held their positions through a 50% Bitcoin decline suggests that digital assets are increasingly being treated as strategic allocations rather than purely speculative trades. Third, corporate accumulation is continuing at a remarkable pace. Strategy's latest billion-dollar purchase demonstrates that some companies are still aggressively building Bitcoin reserves despite the market's fluctuations. Finally, the battle for key support levels in Ethereum highlights the ongoing tug-of-war between bulls and bears in the altcoin market. Whether Ethereum holds its current support or experiences another wave of liquidations could influence sentiment across the entire crypto ecosystem. As we move further into the year, the interaction between these forces will likely shape the next major chapter of the crypto market cycle. Institutional adoption, macroeconomic conditions, technological innovation, and investor psychology will all play a role in determining where prices go next. For now, the market remains in a fascinating equilibrium. Bitcoin is hovering near levels that could trigger billions of dollars in liquidations. Ethereum traders are defending a crucial support zone. Institutions appear increasingly committed to holding digital assets through volatility. And corporate giants like Strategy continue to accumulate enormous amounts of Bitcoin. All of these factors suggest that the crypto market is entering a new phase of maturity, one where long-term conviction and large-scale capital flows may gradually reshape the dynamics that defined earlier cycles. And that's going to wrap up today's Daily Crypto Roundup. As always, keep an eye on those key levels, watch how institutions behave during volatility, and remember that in markets driven by leverage and liquidity, the biggest moves often happen when the majority least expects them. Thank you for sticking with us in what has been a turbulent week, and as always, we will see you at the top.